So before I took on investing more seriously, the whole thought about interest rates was usually something that I just connected to, oh, it's a housing loan or it's a car loan or maybe it's my bank account. I had never thought about interest rates and how it related to investing as a whole, and especially when it comes to US based interest rates. And heck, why should we even care about it? So along my investing journey, I realized just how important it is, especially in today's environment. So in today's video, I'll start with a quick introduction about the US bond market. Don't worry, I won't get too technical, but I'll cover a little bit about the treasuries market, interest rates, and how it affects us as investors, even all the way here in Singapore or Malaysia. Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll save, invest, and feel better about money. So at the heart of it, a bond is a loan. In the case of the US, they are issued by the government, corporations, and I guess they have municipal councils that even issue bonds as well. So think of it this way, these guys are issuing bonds so they can raise money in order to pay for any kind of initiatives that they have. And just like a loan, the two elements are time and interest rate. And in the case of bonds, time can be just talked about as duration, and interest rate can be talked about as a coupon or a yield. Now, most of us will think of loans as a fairly straightforward engagement, right? You and the bank, boom, straightforward, and it's an easy one-way-ish transaction. But for most bonds, it's actually traded on a market. In fact, the bond market is much bigger and deeper than the stock market. And depending on which source that you look at, the estimates are about 119 trillion when it comes to the total world bond market. And when you look at stocks, it's about 90 plus trillion. So let's get into the few essential points that you need to know about the US government bonds or treasuries market, as well as the US dollar. The first thing to note is that US treasuries are massive. It alone is about $21 trillion. And it's so big simply because the US is the most trustworthy country currently. The second point is that the US dollar is the world's reserve currency. And it's so much so that 40% of all debt in the world is denominated in US dollars. And when it comes to most major assets in the world, such as gold, oil, agriculture, metals, they're all priced, you guessed it, US dollars. And needless to say, the US stock market is just humongous and is the biggest in the world by far. The third point to note is that interest rates directly affect the value of a currency. So if you think about it, if the interest rate of a currency is higher, therefore the value of the currency is also more valuable, right? Oh my god, everything is really connected. And it is just amazing just how much influence the US has over the rest of us, even all the way here in Singapore. And if you're enjoying this video so far, I would appreciate your support in clicking that like and sub button or leave me a comment below. Thanks! And if you haven't guessed it already, my big point is that the US interest rates can directly impact economies all around the world. It starts by knowing that governments in general do use interest rates as a tool to control the growth of an economy. And this is especially so in the US. You can think of it as controlling the cost of money. So, say you run a business and you want to expand. So you will go and apply for a loan from a bank, right? So, in an environment where interest rates are low, you can think of it as like money is cheap. And especially if it's free flowing from the banks, businessmen like you are able to borrow more and therefore expand and buy more resources. And that's when problems can happen, because if there's too much money chasing too few goods, prices tend to go up and therefore you have inflation. So when governments see this getting out of hand, naturally they want to control things, right? They want to make sure that the growth is slowed down a little bit. So they'll raise interest rates and therefore raise the cost of money, and that hopefully cools the economy down a bit more. And if you think about it, if a big brother like the US government does that, all around the world, other governments don't necessarily have to follow exactly, but you can bet that they are influenced by that decision as well, because they want to maintain a certain balance in the value of the currencies. And that brings us to today. And if you looked at the US 10-year yield, which happens to be the benchmark interest rates that nearly everybody looks at, it's been dropping for a long time. In fact, it's already at kind of historical lows. And if you combine that with all the stimulus money that has been put directly into people's hands by governments during COVID, you plus that with the supply chain problems that has been happening, all these are contributing to a lot of inflationary concerns right now. So the big question on everyone's head is, will this last? Is this inflation going to persist into the future? And investors are nervous for good reason. And in case you just never really realized, the markets have been doing great. So much so that ever since the low of the pandemic, it has been the fastest doubling, I think, of the S&P 500 since the low point in March of last year. Finally, let's talk about what happens in an environment should interest rates go up, or maybe even the fear of interest rates begin. The first easiest thing is that any form of loan will become more expensive. So that includes all forms of business loans, so therefore the cost of their debt goes up. But it also applies to us as regular consumers, because any form of our loans, whether it's housing, car, credit cards, all those things will go up as well. The second point is that on the plus side for regular consumers, if you were the type to hold money in a savings account, hey, that's something that's going to benefit you, because rising interest rates usually mean banks can finally lift a little bit of those interest rates as well. So even if you paid zero attention to the bond market, I'm willing to bet that last year you would have noticed that, hey, all of my interest in my bank accounts have been going down. What is up with that? Guess what? It's all the US to blame. Next is that prices of stocks will likely suffer. And this is because when people are valuing what a company is worth, they are usually using the base interest rate as a way to factor and calculate that. That's why earlier this year, when you saw a sudden surge in the US 10-year yields, you also saw a pretty steep drop in growth stocks. Next, if you're holding on to bonds, it will also likely hurt, especially if you're holding on to longer term bonds. In case you didn't know, prices of bonds move the opposite direction of where interest rates go. It's kind of weird. And you can see it clear as day if you look at something like TLT, which is an ETF of US long-term treasuries, and how the price moves the opposite direction of where the US 10-year yield moves. Speaking of moves, there are some that you could consider should you want to prepare for the environment of potentially rising interest rates. And that includes players like Stashaway, which I did a video on earlier, and that's what they're doing with their portfolios, gearing up towards a more inflationary growth environment. If you're looking at stock sectors, financials as well as cyclicals tend to do better versus growth stocks in these type of environments. Research also shows that commodities tend to benefit from such an environment, and these could be things like oil and gold. If you were already invested in a lot of different things and you are seeing good profits, another defensive move you could consider is starting to put in some market order stops. So that way, if things do take a sudden tumble, you are assured that your decision has already been made to take those profits off the table. And some might consider holding on to a little bit more cash, because in the event or possibility of a market correction, they will have a little bit more ammo to pick up stocks during that discount period. So those are just some surface level recommendations for you to research into. Please don't take that as face value to go out and make those purchases. As a disclaimer, those last 3 points are what I'm personally doing with my portfolio as well at this point in time. So thanks for watching, guys. I really hope you enjoyed this whole 101 about the US bond markets. If you've got any questions, leave it in the comments below. And if you're feeling generous, I would really appreciate your support in clicking that like, sub, bell button, because I'll be back again next Sunday with a brand new video. And until then, you take care and keep playing your own game.